Welcome, everybody. If I could have your attention, I don't want to take up too much of the time talking about what you're going to be talking about. But thank you all for coming. Thank the panel for coming. I'm Boyden Gray. I'm on the Executive Committee of the Atlantic Council, and I was for 3 years ambassador to the EU, where I had to spend a certain amount of time on financial issues, so I've tried to maintain some interest in what's going on. And the Atlantic Council has a wonderful program called the Transatlantic Finance Initiative, which is run by Chris Bremer. Where's Chris? Just coming in. By Chris Bremer, who doubles in life as a professor at Georgetown Law School. And working with this operation called the Official Monetary and Financial Institution Forum, and I want to make sure that I pronounce it correctly. OMFIF?
You can pronounce it any way you like.
Anyway. And its report, the Global Public Investors Report, I think you'll find it very interesting what's going on in the public sector. And by the public sector, as distinguished from the private sector, I'm talking about sovereign wealth funds, central banks, pension funds, that kind of thing, which has a huge role to play in the post-crisis situation that we're still working our way out of. So I'm looking forward to hearing what all of you have to say. My own specialty when I was forced specialty when I was in Europe was energy, and I could never pull apart energy and finance. There was always a connection between energy prices and financial earthquakes. I could never quite get it clear, but I want it reflected in the record that I was, in addition to being ambassador to the EU, special envoy to the European Union for Eurasian energy affairs. And this was a very special thing to be a special envoy, because there were no other special envoys, at least not in those days. So it was a proud title that I wore. And on my last night in Brussels, I was invited to a dinner. I don't want to step on any toes here. A dinner given by the commanding officer of the European Defense Force. I couldn't go because I was packing up. I scratched my head a couple of times because I didn't really know there was a European Defense Force. But he commanded a house and a chef and a fine staff. And he actually sent me a list of the invitees so that I could better decide whether or not to attend. And I was identified as C. Boyden Gray, U.S. Special Convoy. Now that may have nothing to do with your panel, but that's all right. But I would like to introduce David Marsh now to open up the panel discussion. He's the managing director of OMFIF, which is the Official Monetary and Financial Institutions Forum, and give some remarks about the report that they've just issued. And I think there's going to be more about the relationship between public and private finance. There should be a lot more. There will be more. We are still not totally out of the woods. So thank you very much for agreeing to do this.
Thank you very much, Boyden. Thank you, everybody, for being here. Thank you to our friends at the Atlantic Council for putting on this launch of this book here with you today. There is a link between this global public investor publication and Washington, because just during the summer, the institution known as the Forum of Sovereign Wealth Funds, the International Forum of Sovereign Wealth Funds, relocated to London from DC, where it had been housed in the IMF building, and they've now set up an office in London. And it was partly for that reason that we felt it was a good idea to bring out this book. It is something of an experiment, but it's been so successful that we'll be bringing it out every year from now on. And I'd just like to give 3 pointers about these so-called global public investors, as we have baptized them, simply to explain something of the subject matter of the book and also why these are interesting and why they deserve greater public analysis. First of all, the nomenclature. There's been, of course, lots and lots written about sovereign funds, lots about central banks, and lots about public pension funds. We simply decided we would try to lump together this rather disparate grouping of asset managers. We've just counted them up, and we count up of the top 400 in the world. They have assets of about $29 trillion, give or take a few trillion. I mean, what's a few trillion among friends, I would say? It's about 40% of world GDP. And obviously, this is a fairly heterogeneous bunch of asset owners. The top one is the People's Bank of China, and they range into all shapes and sizes. I think in our survey, there's something like 162 different countries, very well spread around the continents of Africa and Asia, Europe, Middle East, Latin America, North America. A very interesting spread of countries, and of course a great disparity of institutions. But the important thing, and this is point number 1 just to leave with you, is that there's often more similarity between individual institutions in those specific categories and other members of other categories than you might think. To take one example which we highlight, the Swiss National Bank, which you would tend to think is a very august, very conservative institution, probably has to go through a very bureaucratic procedure even to buy some more boxes of paper clips, you might believe. But in fact, they have 15% of their reserves, the reserves are about 500 billion Swiss francs, in equities. So that is about $72 billion worth of equities that the Swiss National Bank owns. That's because they bought a lot of euros in order to keep the Swiss franc from rising, and they've got to invest it somewhere. And the Norwegian pension fund, which isn't actually a pension fund, but it's more a sovereign fund, NBIM, Norges Bank Investment Management, they have far more in common with the Swiss National Bank than the Swiss National Bank has, let's say, with the Bundesbank or the Banque de France. So it was an attempt to put this very disparate bunch of asset managers, there's 157 central banks, 87 sovereign funds, and 156 public pension funds, into some sort of overall context, and to try to compare and contrast these different institutions from many different countries. And as I say, this will now be part of an annual endeavour. The second point is really more the public policy aspects, which Boyden was alluding to. We know that there is a lot of demand for long-term capital in the world as a whole. There's certainly a big supply of capital wanting a home. The difficult bit is joining it up. We all know societies, whether in the East or the West, have got great needs, whether through some kind of societal development in areas like healthcare, education, IT, into all kinds of areas like infrastructure. And you would think, on the face of it, that these long-term investors would have a great deal to offer here. Joining this up, though, in a way that makes sense from an investing point of view and also from a governmental point of view, can be very difficult. I know the United States has declared it wants to carry out a big infrastructure program, and it wants to make these assets bankable. And of course, there's many other countries that are looking for these kind of operations, these kind of sovereign funds or sovereign investors to plug gaps in public finance. Well, I reckon that in the future there probably will be a greater degree of matching up of different investments from different areas of the world. that's where you come into this issue about accountability and openness and transparency. There is a difference, I think, between transparency and openness. I don't think we're calling for every single transaction to be totally transparent, but we're calling for some of these transactions to be somewhat more open. And the Swiss National Bank is a good case in point. They are very open. They do have a website where they put their makeup of their currency reserves, how much is in equities, how much is in bonds, how much is in non-traditional currencies, like, say, the Singapore dollar or the Korean won. And I think it would be good if other central banks that are relatively diversified would do the same. The Santiago Principles that some of you may know about were set up under the auspices of the IMF to try to bring in a bit more accountability and openness for the sovereign funds. And some of these principles might well be applied to other sovereign investors that are now investing more and more in assets on public and private markets, such as in equities. And the third point, which we try to put our finger on, and we'll be doing some more work on that in the coming year, is the question of the investment behavior. All of these public investors are beset by the same kind of problems as you find in the private markets. They are all trying to make returns in markets which are quite low yielding, particularly in the traditional areas of Europe and the United States, and quite high risk. And this is a difficult juxtaposition. Many central banks, for instance, are under pressure because they are not making money and sometimes even losing money on their reserves. The People's Bank of China is a good case in point, but there's many other central banks, large and small, as well as more overt investment-orientated organizations. And these people are actually hunting for yield. It's quite perverse in some ways that the same organizations, the central banks, who are supposed to be there to look after world financial stability, are in some cases looking for yield and possibly going into markets, adding to risks in markets, adding to the danger of overheating in certain areas. So there's an immense circularity in some of these investments, and that needs to be looked at. I think another interesting area of investment behavior which we're tracking is how more and more of these large investment institutions are no longer using the private banks or asset managers, but are disintermediating those agents and doing deals either directly or by teaming up themselves. Lots of co-investments, lots of partnerships going on amongst these different institutions around the world, partly to save money because they are not paying the fees to the private sector asset management organizations, but also to gain expertise. In quite a few cases, the public sector asset management organizations have actually bought teams from the investment banks or from the private equity companies and just taken those people in-house. And I think this is going to develop more and more. The fee structure for, say, hedge funds or private equity funds, certainly dealing with the large public sector investment organizations, the old 2 and 20 fee structure is completely now outdated because the public sector investment organizations, at least the large ones, in areas where they've amassed some competence, are now doing without the private sector and building up their own expertise. So that's a few snapshots. There's loads of other bits and pieces. It's like a kind of bran tub, as we say in England. You dip down into that and draw out anything that you quite like from this very large potpourri of different subjects. The one that we'll do next year will be a bit more structured along the line of asset management categories. So I think it's a very interesting mirror on the world economy, a really fascinating area to look at. This is the book. I've only brought, because I've been in Canada, I've given most of these away. I've just got a few left. We are also selling the book, but I'm not going to get involved in doing anything quite as profane as selling them now, but we are selling them, I know, through the website. So I'd now like to call upon a very erudite collection of personalities. I'm going to ask them to come up a little bit like in the Oscars and ask them to then perch on these stools. I don't know who invented this idea of these stools. I'm going to ask, first of all, and then you have to give them a round of applause, like in the Oscars as they come up, Sarah Bonesteel, who's the Managing Director and Head of Portfolio Strategy of Prudential of New Jersey. So you're well perched. And You've done it in a very exemplary way. There's Sonia Gibbs, who's the Director for Capital Markets and Emerging Markets Policy at the Institute of International Finance. Welcome, Sonia. Clay Lowery, Vice President, Rock Creek Global Advisors, who I know has been to the Atlantic Council many times before. And lastly, but most eminently, Dr. Rakesh Mohan, who's the former Deputy Governor of the Reserve Bank of India and now India's Executive Director at the International Monetary Fund. And if I may add, Rakesh, I think author of a seminal report on the Indian railways and how they're all going to be restructured and made much more modern.
How they should be restructured, not how they're going to be.
Well, maybe under the new government. So it is my privilege also, as well as leading off the conversation, to be the moderator and also, of course, to ask questions from the audience. I'm sure there will be questions forthcoming. I'm going to lead off, first of all, if I may, with you, Rakesh. As I was saying, we are trying very much to give a global viewpoint of the way that these large asset management companies in East and West, North and South do actually behave. Do you see this whole issue of sovereign investments, particularly by Asian entities? The research does show, of course, a huge concentration of wealth now resides in Asia, whether in South Asia or Southeast Asia or in Eastern Asia. Do you think this portends some kind of real large shift in the world economy? Because you could say this gives those countries also a great license to lose money. We all know the People's Bank of China has not been a very good investor of assets because it's got a huge preponderance of money in US Treasury bills. And also this shift into equities that I was mentioning, do you think this is something itself which those large funds from Asia can manage? Do you think it's a good thing, for instance, that central banks, you are a central banker, are moving into equities? Could you just give a few global perspectives on all these thoughts, please?
Thank you, David, and thank you for inviting me to this session. As you've outlined, this really is a very broad subject. And before I come to what the specific question you've asked, you've talked mostly from the supply side of funds. So I'll come to that later. Let me first talk from the demand side for funds, because that is not often talked about enough. What is very interesting to me is, you mentioned that I have worked on the Indian transport sector and the investment that we need in the Indian whole of transport infrastructure, whether it's railways, whether it's airports, etc. But what I found even more interesting is that there is a vast global need for public investment in both OECD countries now, which I had not realized. And in fact, I learned something from your report, that public investment in Europe was around 5% of GDP in the 70s, and it has come down to 2.5% of GDP now. And just yesterday, I came across an article that has come, I think, in Der Spiegel, if I'm not mistaken, which I was totally taken aback by, is that it said that public infrastructure is crumbling in Germany. I never would have thought of that. It's from a German magazine. So
it's probably crumbling not quite as much as it is in India, but everything is...
In India, it's not crumbling. It wasn't there. So there's a big difference, David.
I thought it was the British infrastructure that was actually crumbling in India.
So the point is that a lot of infrastructure was created in Europe, all of Europe, in the United States also, 50s, 60s, 70s. And so you're now talking about infrastructure that is 40 to 60 years old. And so obviously it needs huge renewal, which it doesn't seem to be happening. So there's dire need for renewal of infrastructure. That means huge need for public funds in the OECD countries for a start. And then, of course, in the emerging markets, whether it's India, China has already done a great deal. They'll need to do more. Other country, Indonesia, I mean, these are all large countries, Indonesia, Pakistan, Bangladesh, Vietnam, they're all huge countries, actually. And then, of course, Africa, as it's now coming along in terms of growth and so on. And all need public infrastructure investment. What is also interesting to me is that there's been a traditional role for public infrastructure banks. And so I hadn't quite realized that, say, the European Investment Bank invests, I think, 3 times or 4 times the World Bank in terms of disbursements. And yet European countries, US, say that emerging markets don't need public infrastructure banks, even though they themselves have a huge one. Nordic Bank as well. Of course, China has huge policy banks. Brazil has huge policy bank. So the issue really is that there has been a lot of global discourse in recent years, in some sense decrying public investment and emphasizing the potential public-private partnerships. And whereas I'm the last person to say that public-private partnership is a bad idea, because it's not, it's a great idea. But I think the global experience tells us that it's only successful at the margin, at most of infrastructure, is indeed from public investment. So all of this is just to say that there is a huge demand for public funds for infrastructure, both in developed countries and in emerging and developing economies. And perhaps the public funds from the supply side that you've been talking about can think much more of how those funds can be channeled in this direction. And of course, at the same time, how public infrastructure funding can be more efficient and gives returns. And one of the things that I've learned in the work that I've done in infrastructure funding is that one example is Germany, where fund briefs have been used forever, where about a dozen or so mortgage banks that raise money through fund briefs, and fund briefs are just a little below the Bunds in terms of their credit quality. That's been going for almost 100 years without any failure, even through the 2 world wars. And so there is a market out there through which funds can be provided by these public funds, which then get translated into infrastructure. The US has had a somewhat different structure, basically through municipal bonds. And again, apart from very rare failures like Detroit recently, municipal bonds have not failed. And again, it's a huge capital market through which actually private funds go off into municipal bonds, which then fund public infrastructure. And so my point is that what you were saying towards the end, that you need to find ways of how to connect these two. And it does seem to me that more thought needs to be given on using the capital market as an intermediary between the suppliers, the public funds, to the demanders. And to some extent, the point I'm making is that there hasn't been enough thought given to how these intermediaries, which then invest in public investment, how they raise their funds, and maybe they need an intermediation between the public funds. So much for the demand side and the supply side. As you mentioned, you have 3 categories of public funds, of public investors: central banks, sovereign wealth funds, and public pension funds. Now, I think we do need to understand the differences between those 3 categories, even though they may be obviously overlapping at the edges. And as you're saying, the central banks are also now going into equity. We do need to understand first that there's a direct link between the size of central bank balance sheets and monetary policy. And very often when people think about central banks operating sovereign wealth funds through the reserves, forget the connection between the central bank balance sheet and base money, which is then connected to broad money. And so you need that as central banks expand the balance sheets, there's always a liability side. And so you need to constantly think of what the central bank is doing on the asset side when it acquires these reserves, which then has to invest. Second point is that within that, if emerging markets, the fast-growing emerging markets like ours, if the GDP grows at nominal rates of 10 to 15%, depending what inflation is, what the real growth is, then you're sort of talking about the need to expand central bank balance sheets by something similar There isn't, of course, a one-to-one relationship. The relationship keeps changing and so on. But the fact still remains that as these economies grow in size, there will be an increasing demand from their central banks for reserve assets, and therefore supply of treasuries or whatever. And that is an issue in terms of looking at perhaps ahead on what kind of magnitudes of central balance sheets growth is needed, where they would invest. Third point there is this issue of safe assets. As a former reserves manager, I wouldn't have been caught dead investing in equity, because the question is, who is authorizing me to do that? That if you're in a democracy in particular, that if I invest in equity, and whereas I know that over 30 years or something that I'll do better than I do in bonds, but I have no idea what's going to happen in the next few months. And who then is responsible for those public funds, central bank reserves going into equity, and you lose 15%? And what is the mechanism for authorization for investing in risky assets on central bank reserves? I don't have an answer to that, but as you're saying, some central banks are doing, like the Swiss National Bank in equity. I would be curious to know how the authorization procedure goes, and how do civil servants essentially take those risks. And so my view certainly has been that central bank reserve managers have to be very conservative, both from the point of view of the function of the reserves and the central bank balance sheet, but also who's authorizing me to take those risks, and how do I get those authorizations? And in any case, the objective of central banks is to preserve financial stability and not necessarily in getting returns. Second, sovereign wealth funds. Sovereign wealth funds have arisen basically either from countries such as China, and Singapore, which have persistent current account surpluses, and same thing also, but perhaps more concentrated in countries like Norway, Saudi Arabia, other oil-rich countries where it has come from just one commodity. And they do have, and what they're doing is to try and ensure themselves and their countries for the future, because these are exhaustible resources. So there is an issue of maximizing returns for the future, but maximizing long-term returns. And it seems to me that this is where the first part of what I was talking about comes in, that to the extent infrastructure provides returns in the long term, what you want is to connect those wealth funds, sovereign wealth funds, which have a long-term view, then investing in public infrastructure, public investment banks, etc., or through the bond market, where you do get certain degree of sort of safe, but not as safe as central banks, in terms of returns. Finally, pension funds, they're kind of similar to sovereign wealth funds, but the difference, of course, is in the origin of the funds that they get. And again, they also need to be safe because the pensioners' lives are in their hands, but they also obviously need to maximize returns. So again, the issue, basically, to my mind, comes down to how do we direct these large funds from sovereign wealth funds, pension funds, into public infrastructure, including health and others, because they are sort of connected with longevity and safety, but providing social returns.
Good, thank you.
Can I just...
Please, just jump in, just a very short
as we were
interjection.
instructed to jump in,
yes.
I will jump in just briefly. I just wanted to add, that was a remarkably good summary. I just wanted to add one small point on the supply side, and that is from a private sector perspective. So the institution I represent is a private sector, banks and investors and so on. The deleveraging, especially of the European banks, has played a big role in the lack of funds for infrastructure investment, right? Because especially some of the big European banks were major investors and financiers of infrastructure investment. And with that deleveraging, which is ongoing, they've really retreated from those markets in all but the very shortest maturities. So I think that adds to the compelling need for funds for infrastructure investment.
And just to pile on, you could add Solvency II for the European insurers as well, which is also creating capital charges that are punitive for very long-term investments.
Could I ask you, Sarah, actually just to elaborate a little bit on what Rakesh was talking about, the linkages with the private sector? I mean, for instance, at Prudential Financial, do you have a team that is reaching out to these funds in areas like infrastructure to say, what can we do better together that we might start doing by ourselves, but we'd have more firepower and perhaps more long-term investment thinking by linking up in this co-investment approach. Do you have teams of people scouring the world for sovereign opportunities?
Yeah, so I guess to back up just a little bit to sort of orient us in the spectrum of investors, I'm here representing Prudential Insurance today, which is the insurance entity within the bigger Prudential Financial. I am responsible for strategy for the insurance companies, and we have approximately $400 billion in assets, in dollars. We do indeed have a dedicated team that is doing infrastructure investing for us, although we find that we've historically done it in any way, regardless of whether we've got a dedicated team. We took sort of a backward look at our portfolio to see what do we actually have in hand that one would say is infrastructure, and the number came out to around, depending on how you define it, about 20 billion. And so approximately 5% of our portfolio is deployed right now in infrastructure type investments.
Is that all in the United States, or is it spread all over the world?
That's spread all over the world. Yeah, roughly half of that is public, so it could be public issuers. That includes some municipal bonds. Municipals are not a natural asset class for a life insurer like us, but we have found opportunities here and there to do those. Build America bonds in the U.S., certainly very attractive to us. But it also includes some non-U.S. investments, but primarily in the developed countries, predominantly the UK, Australia is where we have most of our infrastructure investing.
And Sonia, yes, you may well have a point you'd like to make anyway, but one point that I wanted to bring out is this public policy area. Do we know enough about these investments? Rakesh, who's a seasoned central banker, you were frankly astonished that the Swiss, the swashbuckling Swiss are now moving into equities. You said you wouldn't be seen dead doing that kind of thing.
I would have been dead if I'd done it.
You would have been dead, yeah. Well, depending on which equities, I suppose. You might have been living in the Bahamas, you never know. But Sonia, do you think we need to know more about these things, or is the IAF going to mount a call for transparency now as a result of these findings?
Transparency is our watchword. But I think infrastructure in particular, the illiquidity of the asset class and the lack of available instruments for investment in it. I mean, you have a big disconnect between investors, like Prudential, who would like to invest more in infrastructure investment, and the availability of ways for them to do it. In fact, one of the working groups that we run is our Council for Asset Investment Management, and that is sovereign wealth funds, pension funds, life insurers, and asset managers, large asset managers like BlackRock. Together, they represent something like 20 trillion US dollars under management. And what's interesting about that is when we spoke to them and looked at various surveys, many, like Prudential, would like to be invested perhaps as much as 5% in infrastructure investment. Most of them, on average, have only about 1.5% in infrastructure investment. And it's that. And even, if they were able to move closer to 5% by even a percentage point or two, that would add a great deal to the supply of funds for infrastructure investment.
Do you include municipal bonds in that?
I beg your pardon?
Do you include municipal bonds in that number?
No.
You just include the actual underlying assets?
Yes, infrastructure.
And what is holding them back then? There's just non-availability, because you'd think they'd go along to a few town halls or to a few governments and bang a few heads together.
Well, I think one is the lack of tradable instruments and the lack of a market, because it's much easier to get in and out. There are regulatory factors, as Sarah mentioned, Solvency II, capital charges for banks, that make the economics of investing in infrastructure difficult for many to work. But then simply there is a lack of access to information about infrastructure investments. And so ways to facilitate data collection and promote harmonization across borders for this type of investment. And then the investment framework, the policy framework in the countries that they want to invest in. For example, you want to be part of a bridge in a small emerging market country. How sure can you be that the policy framework is in place for you to do that safely, especially if you're a fiduciary, right? Yeah. I mean, if the government could tomorrow change the tariff structure or the taxation structure on this investment such that the economics of the deal no longer worked for you, You know, where would you be then? And a lot of the investors that we speak with cite this policy uncertainty as a major impediment to infrastructure.
Well, funnily enough, I was talking to a big investor the other day in Canada, and they said exactly that. And they said they now only go into deals where the government gives them some sort of indemnity that they're not going to change policy, which could be very costly for the taxpayer. Just like to go on to you, Clay. I mean, this looking at it from a broader policy perspective, we're not just talking about infrastructure here. We're talking about a whole gamut of different investments. And there's a lot of schizophrenia around because, as Rakesh was saying, there's little individual elements of central banks or sovereign funds where you can be a bit more risk averse in some area and you have to be very conservative in other areas. So you're asking institutions to actually carry out a lot of different practices, which maybe they haven't really been fully trained to do, or may not be properly incentivized or indeed protected to do. Do you think we need a wholesale new look at also the regulation of some of these large institutions? Because in a way they are both poochers and gamekeepers, it seems to me. They're operating on both sides of the divide.
Well, I mean, it's a great question, which is how do you regulate the regulators, right? Or supervise the supervisors. I have a point that is, I think, related, but is slightly different. So I was involved back in 2007 and 8 when we came up with the Santiago Principles, and in many respects, it was a matter of looking at the sovereign wealth funds and fighting the last war. And for us,
they were thought of as being rather dangerous. They wanted to come in and take over all sorts of good American assets.
Sort of. Perception, not reality. So the perception that we were fighting off was because there was a state-owned enterprise, not a sovereign wealth fund, called Dubai Port World, that actually was trying to buy some assets in the United States, and frankly, perfectly legitimate transaction, and it blew up in the press and it became an absolute catastrophe from a public policy perspective. And so we were worried because you could see.
Sorry, who is we here?
We was when I was at the U.S. Treasury Department and in the government, I'm sorry. And so we were very worried about the problem that if you have a sovereign wealth funds, which nobody even knew what that was back then, you had these growing assets. They were coming from the Middle East, and now there was something being created in China called the China Investment Corporation. And this was going to give rise to these protectionist pressures that we saw very dramatically back in 2006 in the Dubai Port World transaction. So our solution was, for once in our lives, to get in front of the problem instead of stay behind it, and to basically actually try to come up with a set of principles on transparency and accountability, and that's what, in the end, the Santiago Principles were. Now, was it a perfect document? No. Have they been implemented perfectly? No. But I'll promise you, given if you looked at the policy statements that were being made in 2006, 2007 by very, very smart economists, some of them who have served high up in lots of administrations, Republican and Democrat, they were wrong. And instead, pushing an agenda to basically get people to realize that these things were not out for evil purposes was an important thing. And I say all that because now what is the policy landscape? The three folks up here who know a lot more than me have already kind of told you a lot about what it is, which is there is a demand for infrastructure financing. The supply side of that is who's going to supply it and what are the terms that they need to supply it under. And I think that one of the key things, if you look, so I have something to say about the G20 meetings that happened over the weekend about this very issue, but in there's a statement about the World Bank is going to be working on a global investment facility and global investment initiative or something like that. And but part of that is about how do you disaggregate these infrastructure financing facilities. So if you are a bank and you are investing, I think Rakesh is right. Most of the investment infrastructure starts with government. Then banks come in. But banks they can be flexible beasts and they don't want to stay in for very long. How do you then get to the next stage where insurance companies come in, pension funds come in, sovereign wealth funds can come in, And I think that the problem we've had is, from a policymaking perspective, again, is you have the supply and the demand side are talking in aggregations with each other. And sometimes I think you have to disaggregate it to come up with the type of information that Sonia was mentioning.
Okay, well, that's a very good point. I think segmentation of the market is a good thing. I'm sure that when we open up the floor to questions in a few moments, some people will have thoughts about that. Rakesh, I just wanted to ask you about infrastructure and the bank, because it's all getting rather confusing, all these different infrastructure banks. Clay mentioned the institutional angle. You've got the new BRICS bank to be based in Shanghai. That's more balance of payments, I believe. But then you've also got an Asian infrastructure bank. Could you just very briefly tell us about these new BRICS banks and also tell us whether they're really going to go anywhere?
Well, first, the BRICS bank is not for balance of payments. What is for balance of payments is the currency reserve arrangements. And they're two very different things. It's like the IMF and the World Bank, essentially. Yep. So the BRICS bank, as far as I understand it, is essentially for infrastructure investment. And just like you had in the past, you have the World Bank, you have the EIB, you have the EBRD, you have the ADB, you have the African Development. So it's another one. Another.
And what about the other one, which is also going to be infrastructure, but maybe a broader base? Are India and China going to go marching off hand in hand to set up this new bank?
That I quite frankly don't know much about. The BRICS bank is the first 5 members are, of course, the BRICS countries, but it's going to be open to anyone else who wants to join. So it's not going to be narrow. It's not supposed to be narrow-based.
I can actually comment on the AI. So the Asian Infrastructure Investment Bank, which I think is primarily a Chinese proposal, and they've wanted to do it from a regional perspective. I think the way they're trying to set it up, as far as I can tell, is very much like the European Investment Bank. Most people in this country don't know anything about the European Investment Bank. I think that in some respects, it's interesting because I'm sure it's very difficult if you are a U.S. government official to think about, so the Chinese are setting up a regional bank that maybe India will join, Korea may join, Malaysia may join, and so forth, and the U.S. can join as a minority owner or something like that. It'll be tough because it'll be financing that the U.S. government won't be able to come up with, and you're going to have to overcome some of the political issues that are around it. But that said, in the same respect, it's a way of trying to figure out how to you use assets in reserves in a more productive way for regional infrastructure that is going to be desperately needed throughout South Asia and some parts of East Asia. So I think that it'll be an interesting thing on the AIIB because it is a new proposal, and it'll be interesting to see how it plays off with the BRICS Bank that's being created.
Sarah, could we go into this issue about co-investment, which I was mentioning earlier on, about how these institutions are more and more teaming up with each other, but they're also trying to disintermediate the private sector institutions. When you're looking at these large groups, which we've said are all very disparate, but they're all building up expertise in lots and lots of different ways. Do you look at them and you think, well, in the past they were people who gave you money to manage, but in future they're going to be your competitors, they're going to be eating your lunch? Do you have that feeling?
We're certainly witnessing some of that now, yeah. I mean, we're fortunate enough to be large enough to have an established team of our own, and we've been in these markets for a significant amount of time as a principal. We don't use an outside manager to do this. We do this directly as much as we can. That being said, we do club deals, certainly. We'll do arrangements where we are sharing a particular project with several different insurers or several different investors. Keep in mind that these projects tend to be extremely lumpy, and so if you're talking about an investment of several $100 million to maybe a few billion at a time, it's really too large in some cases for a single investor to take down the entire issue, nor would they want to. It's good to have the expertise that others can contribute. So yeah, we certainly have been involved with others in club transactions. And then you ask about disintermediation, and are we finding ourselves sort of taking the place of banks? And I would say that is the case. We are seeing that in any event, banks tended to lend shorter, particularly in Europe to begin with, typically inside of 5 years. We can offer those who need funding an alternative because we actually prefer the longer investment. It's a better match for our liabilities. And yeah, there are a number of unique qualities about infrastructure investments as an investment prospect that we really value. I mean, certainly the very long average life is terrific for insurance liabilities, and it also allows us some diversification. If otherwise we're looking at corporates, or perhaps we're too focused on our own home market, this potentially gives us some opportunity to diversify.
Just carrying on this principle of partnership, Sonia, one of the things, and also the principle of diversification, one of the things we notice is that more and more rather established, rather staid pension funds from Europe want to get an exposure to Africa these days, and who better to do it with than some local African sovereign fund. There's many, many sovereign funds that are now being set up because they know the localities, they can do the due diligence and so on. On the other hand, it takes quite a bit of doing to get, say, a public sector Swedish or Netherlands pension fund to actually team up with, say, the new Angolan sovereign fund or a new fund from Ghana. You have to travel out to the area. There's all kinds of institutional rigidities and so on. And yet both sides want it. The African fund will want to have the safety and security, the badge of honor, if you like, with a North European fund. And the North European fund will want to have the feeling of having some local player that knows the landscape. Do you have any ideas on how we overcome this disparity? Because it's been a constant feature of this conversation that there's lots of supply, lots of demand, but it's all in the wrong place.
Well, I think just to back up for a minute and think about the comments that have been made on the idea of competition, perhaps. I mean, I think it's fair to say that the enormity of the gap in the need for infrastructure is such that there is room for every single type of player imaginable. The trick is simply to facilitate this happening. And one of the problems, as you point out, is that the different initiatives that are being done, the government of Singapore, CIC, private investment firms, banks, the one hand does not know what the other hand is doing. So some sort of portal or data repository, and this would probably need government backing in order for it to function appropriately, would go a long way toward getting rid of this sort of information gap that hinders a lot of these.
Isn't there lots of information out there with news wires and specialist services and things like that? What you're talking about something additional to that?
I'm talking about more specific information about, for example, pipelines of deals that will be coming up in future. You know, how you go about finding the information on the deal that matches your particular needs.
Isn't that why the investment bankers earn so much? Because they're trying to find that out themselves. Or do you want to take over their jobs as well?
I think it's not so much a taking over as making it easier for a range of players to work in this space. Because, you know, to get 57 trillion or whatever amount we need by 2030, you need the institutional investors. The governments have to carry on doing what they're doing. In many cases, those governments face constraints with the levels of debt that they have.
Okay, well, that does actually play out to the question I put.
David, the organizing principle for the intermediary between putting the two supply and demand together, to my mind, in this sphere, is to different kinds of credit enhancement. After all, that's what the World Bank does.
The World Bank guarantees for certain tranches, for example.
The whole structure of the World Bank is to do with collective guarantees, which are not to be called, so to speak. The day they are called, the World Bank finishes. But that in principle is that credit enhancement function of the World Bank that allows it to float AAA bonds, which suppliers of funds then invest in. And it's true for all these investment, all these development banks. Similarly, I would say municipal bonds are a credit enhancement deal. Fannie Mae, Freddie Mac were credit enhancement deals. Now they're a bad word. The fact of the matter is, for 60 years, they served the United States very well in terms of connecting suppliers of funds to a very disparate set of borrowers, that is, mortgage borrowers. But there was this whole structure, or there is still that structure. So to my mind, a lot of that there isn't enough creativity in thinking, in looking at the new infrastructure needs, and what kind of credit enhancement models, be they Pfandbrief type, be they municipal bonds, be they development banks, that you need to put in the middle so that the pension investor feels safe.
No, it's a very important point. In fact, if you look at people like the IFC, they are now packaging up loans and turning them into securitizable equities, which are then being sold to these kind of institutional investors. So we are seeing that. I'm going to ask the audience to open up in a moment, so please do have some really scintillating knockout questions ready. But before that, just to the panel as a whole, there is a bit of schizophrenia about the attitude of the West, shall we say, to funds from the emerging markets, because, as was pointed out by Clay in 2007, they were thought of as being like the marauders who were going to be coming over to engage in our markets and sort of take over assets which somehow they shouldn't have. And then suddenly, with the financial crisis, the whole situation turned around. Suddenly, they became very sought after, and people were beating a path to their doors, and often sold them assets which they shouldn't have done, as it sold them banks, for instance, at far too high prices. Would anybody like to comment? I mean, Rakesh, you are the obvious person to comment on this.
No, I think there are much better comments.
Who would like to comment on this? Where are we going to settle down? We either we love them or we hate them. When are we going to settle down? Sarah, you can give us a sound, sane answer. How should we look at these sovereign investors? What place in our hearts should they have?
What place in our hearts should they have?
I know you have a heart, don't you? We're coming from New Jersey. Yeah.
Well, my vote is that they do settle down in one direction or another, and I think that is a central issue with infrastructure investing. Is that in addition to the commercial dimension that you might have in other investments, you've got this political dimension that's really hard to analyze and understand, and that's a core problem with this whole sector.
Anybody else want to answer, please? Sonia?
I would just say that this is a new world. I mean, the emerging market domestic investor base has grown tremendously. Sovereign wealth funds are obviously part of that, but that's not the only part, the private sector investors as well. And along with that, the universe of emerging market bonds and emerging market equities that are out there for investors to the field to play in has just expanded by 4 or 5 times just over the last decade. So it's just something that the global investment community has to come to grips with. They're here to stay. It's not going to change. It's only going to, the balance is only going to tilt further still in that direction, I believe.
The only thing I would add is I did have to used to look at for national security purposes investments into the United States. And I think as long as you have a set of rules or principles or what have you that investors understand, whether they're public sector investors or private sector investors, and they're doing cross-border investment, and it doesn't appear that there's capriciousness to it, I think that you can handle this in a fairly
and would you say, Clay, that the Santiago principles in which you did have some handle, you made a contribution to that, do you think it would be a good idea, imperfect though they are, that they should be extended to a broader set of institutions? Because at the moment there's about 28 institutions who say they either fulfill them or they're moving towards fulfilling them.
It's a good question. I mean, so you would be talking about whether or not you extend it to, there's three.
The Swiss National Bank, for example.
3 classes. Central banks, which you said, I actually thought Rakesh pointed out very well. These institutions do very different things. I mean,
at least we thought they did.
How about the Federal Reserve as a big investor? For instance, they don't invest in equities, though. I think it would be hard to do that. I think, but it's always worth exploring. I mean, look, one of the bigger problems, frankly, we're not talking about today is state-owned enterprises and how do they invest and so forth. And when you hear people worry about real national security problems or they're not sure about it, they're actually mostly talking about state-owned enterprises. They're not talking about sovereign wealth funds. They're not talking about pension funds, and they're not talking about central banks. But we don't have anything to really address those issues, and it's really complex to do.
Well, we'll add them to next year's global public investor, and then they'll have reached the age of maturity.
I wish you luck.
Any thoughts from you on sovereign investors? Like them, hate them, love, hate, schizophrenia? Give us some thoughts on that.
To some extent, I sort of understand the concern in any country on investment from a sovereign fund that is controlled by a government. And so issue in some sense is, can you insulate these sovereign wealth funds enough from the owner governments? Now, maybe that's not feasible because after all, they are their owners. To the extent that you sort of don't think of, say, CalPERS being controlled by the state of California. So there is an understanding in the market somehow that this is a separate institution governed by its board of trustees or whatever equivalent that they have. So it seems to me that's, to my mind, say in India, if I was in decision-making position, I would be concerned.
You would?
I would be
Yes.
concerned by some large investments coming from some foreign government-owned entity.
Wouldn't it
as
depend
opposed
on the
to
government?
Funds. No, any, because you never know what may happen to a government.
Okay, well, on that inscrutable note, let's open it up to questions. So please, sir, perhaps there's a microphone here, even though I'm sure you've got a very loud voice. Could you tell us who you are as well? And try to make the question very pertinent and very succinct.
I'm Harlan Ullman with the Atlantic Council. I'm also a recovering capitalist who lives in a third or fourth world city, namely Washington, D.C. I have two questions for the panel, and thank you for your comments. First, what do you see as the greatest, most dangerous ticking time bombs in the global international financial system right now? And second, regarding infrastructure, I have long advocated a U.S. federal organized private-public infrastructure bank that will be financed by the private sector, possibly through repatriated capital from abroad, of which there's an awful lot, funded perhaps at 200 or 300 basis points above prime and guaranteed by the government. And yet, it has been impossible over the last 10 years to get the Congress to understand or even to react on this, even though there have been a number of proposals made. So I wonder what you think is the greatest stumbling block in the U.S. side to the establishment of an infrastructure bank, much along the lines of the 54 National Defense and Highway Act.
Right, wonderful question. Who would like to give an equally wonderful answer? Yes, Sonia.
I could just speak to the first of those questions and leave the other one to Clay, I think.
This is the greatest danger.
The ticking time bomb question, yes. I don't know as it's so much a time bomb as more like a prospect of an eternal damp squid. But in looking at
I know what I would rather have.
But no, in thinking about the current very low interest rate environment, if you look out at futures markets and you look forward, say, a year, 10 years, 15 years, in the United States, rates over the next 30 years at the 10-year maturities, or at any maturity spectrum, are never expected to go above 4% over that whole time period. Now, the markets could be wrong about this. Markets often are. But it's just a terrifying thought. And in Europe, it's worse still, below 3%. Same thing for Japan. How do we continue to operate in that kind of environment? And given the indebtedness of so many mature market countries, which just has not been coming down.
It's a very surreal answer. So your greatest fear is not the time bomb, but the absence of a time bomb.
Well,
the
absence of volatility, the absence of returns. How do you operate in that environment? And what does it all mean for sort of global growth and in deflationary pressures? That's what keeps,
Okay, Clay, you've been nominated to answer you're responsible for Congress now.
Okay, so first, I'm not going to pass up on the first question because I think it's really important. I actually pretty much agree with Sonia. I don't see it as taking time bomb, but given this panel...
Well, if you agree with her, let's go on to the next question. Then.
There's an important point here, David, which is that basically, look, I mean, the Federal Reserve is sitting on a humongous balance sheet. How do they actually manage that balance sheet, I think, is going to be one of the most important questions over the next few years. And let's not think, just because the Federal Reserve is probably by far the most competent public institution we have in this country, it is still a new world that they're in. All right, now, on your second question about an infrastructure bank, I think there's a couple things at play here. One is, I think there's a lot of people in this country who do not believe in the idea of an infrastructure bank. They don't believe in the idea that the public sector should be playing that much of a role outside of trying to set the environment correctly, make sure that the regulations make sense, the tax system makes sense, et cetera, and just let the market do things. All right, so that's one part of it. There's a second part which is, I think, and this is, I think Sarah can help me through this a little better than I can, but the municipal bond market takes care of a lot of the public sector investments in this country. Now, does it take care of enough of it? I don't know the answer to that. And obviously, we see that our infrastructure, to our earlier conversation, has been falling apart slightly. I think those would probably be my two main reasons. And third would probably be there's political problems. I mean, which is that, you know, it's hard to get Republicans and Democrats to agree to a lot of things, and this is one where you would probably much have to try to get some real serious agreement, and that's a tough issue. And we have a lot of other issues that we're fighting about, so that one. But that's kind of today's environment.
A question. Let's have this bundled together, these two questions. So, first of all, gentleman behind Chris. Yeah. No, I wanted him to go first, and then.
Thank you.
He looks even more erudite than
I'm
you
Mel
do.
Tanino from the IMF. My question is very related with what Rakesh was saying at the end. Given the fact that there's not enough public money around the world to finance public investment, public infrastructure, how can you cope with the risk that a foreign government, through its sovereign funds, go and control public infrastructure in another country? So which are the safeguards you can set up? Because the risk I see with these sovereign funds is that since at the end of the day, they are backed by the governments and they act on the basis of some indications from their governments, the big risk is that they go and buy basically all the infrastructure of another country.
Okay, well, let's have your question as well, Chris, even though it may have nothing to do with this question. Just show, please, put your question as well, and we'll answer those together.
I mean, maybe I should just give a chance, because it is a little bit not like that one. So.
No, it doesn't matter. No, we are very intellectually flexible up here on the panel.
Okay. All right, I'll try.
And we won't forget his question.
I will try to tie it circuitously. So
you don't have to try.
One of the things I thought was very interesting in this discussion is to the degree to which infrastructure dominates the conversation. Most people, when you hear the word infrastructure, you're not thinking public investor. Instead, you're thinking public issuer or borrower, right? That is, you're thinking to yourself, how is a company going to attract the capital necessary to upgrade its infrastructure? Traditionally, you've had a variety or different phases through which this has happened. You've had, obviously, the state-to-state lending programs and the international organizations. You've had increasingly, and I find that there hasn't been too much discussion, sort of the project financing, and I don't know if this is because in a kind of post-Basel III world, you know, the capital charges on what were off-balance sheet arrangements have now made those financings less attractive. But we've also now moved on to a situation where the infrastructure financing for some emerging markets, at least until recently with the fallback on QE3, was actually quite attractive to the extent to which a country would now turn to the capital market itself.
So what is the question?
If you'd let me finish, I'll get to the question. Let me just finish, David, let me finish. And at the end of the day, to the extent to which a country then can access those capital markets, experts proclaim that this is now going to be this new nirvana, right, of infrastructure financing. That ultimately, when Ghana, for example, decided to forego its traditional World Bank IMF financing, but instead to start to issue these sovereign issuances, that this would provide a source of capital. Were those proclamations too early, or when we talk about infrastructure, should we be a bit more circumspect and a little bit more thoughtful about what country we are talking about? Do the infrastructure financing challenges in developed markets, are those different, say, from the infrastructure financing challenges that we'll see in emerging markets? And the last thing is, this morning I spent an hour talking to an asset manager in China. The Atlantic Council is very involved in this question of RMB internationalization and questions of infrastructure finance. And what they've discovered is in Shanghai, many of the attempts towards capital finance has to do with the state government thinking through means by which the government can finance bonds through capital account liberalization, which is expanding the balance sheet of not only the central bank but other private investors. When we have this increasing universe of financial products, is this going to ultimately assuage the demand problem on infrastructure finance? I mean, to the degree to which you have new kinds of products, hedging products, derivatives products, bonds issuances, is this a problem that is potentially self-correcting over time?
Good. Well, let's first of all have the point about whether foreign funds moving into infrastructure could be thought of as a bad thing. Rakesh, in a way, you've given your thoughts. Does anybody else have a thought about this question of the danger side of things?
Well, I mean, I think that look, it has to be looked at. If you're doing a national security review, you should look at those issues carefully. I will say, I remember when CIC invested in AES. AES runs the public utility system in Indianapolis, okay? So basically CIC was now going to be the main investor in the public utility system in Indianapolis. I don't know what's happened to that investment, but I mean, but in my mind, I can't believe that CIC was actually going to sit there and try to figure out how to undermine the infrastructure of Indianapolis. I think they were just trying to figure out how to make money. But that said, that doesn't mean that it shouldn't be looked at from a national security perspective, because obviously we don't want the people of Indianapolis to be in a fright over something, and they want to make sure that they get their utilities. But I think it's a good question. I think it always should be looked at. I actually agree with Rakesh, which is, as a public policy official, you would have to be worried about things like that, but that doesn't mean it is verboten. So
but surely there's also a question of safety in numbers. Quite often where these public sector investors do take stakes, they're often teaming up with others, aren't they? Happen, say, with Heathrow Airport or Thames Water. So it's not just one entity taking it over. Anybody else got a point on that first issue? We can also, let's go into Chris's point also about the differentiation of these different infrastructure deals, and also the renminbiization issue, which you've thrown in as well. Let's answer that one too. Who would like to go? Sarah?
Well, I guess to the extent you can be more, I mean, what is helpful is homogeneity, and the fact that we have these projects that in themselves, each one has its own challenges and risk points that can be kind of run down to some lesser or greater extent. It's really challenging as an investor. You know, you need to bring in a Ghana expert, or you need to know someone who's knows the last 30 years of political history of that part of Africa. It can be very challenging. Now, that being said, Rakesh had earlier talked about fond briefs and other guaranteed structures, and we actually have made an investment in Ghana, and the way we did it was through a ECGD guaranteed loan. So it was an export credit facility, the UK entity that guarantees credit, that enabled us to finance an investment in a hospital in Ghana.
So was that equity? Was that securitized in some way, or was that debt?
Yeah. But would we have done that without some form of government guarantee? No. It was just out of our risk tolerance.
So yeah, and then there's a gentleman at the back.
I would only add that to Chris's point, I think that the differentiation point is a very good one, and there are a lot of investors out there who, in fact, when we bring up the idea of more standardization, transparency, harmonization, disclosure, documentation, they say, well, hang on, what I'm after is alpha. I want the investments to be very illiquid, and I'd like it to stay that way. I think our broader point is that there is scope for both, right? I mean, I think that, and that's what will happen. There will be different market segments. But the need for a broader, more investable asset class is pretty great. A firm like Sarah's can do a lot of due diligence and has its own team and so on. There are a lot of smaller firms who might like a piece of the action, and developing an asset class, a proper asset class, doesn't impede still having very liquid investments as well. I think that's,
if anything, the more liquid version sort of enables perhaps the later investment in the less liquid, more interest. Let's call them more interesting investments with a few more risk factors that you have.
Well, this is the point that we were talking about, the segmenting of the different maturities as well. That there may be some high risk assets at the beginning of a value chain, which will then get sold off fairly quickly, and then relatively low risk later on will get sold to, say, insurance companies. There's a gentleman here with the pink shirt, please. Thank you.
Hi, Marty Weiss, U.S. Congressional Research Service. My question is on the infrastructure financing and the public sector side. Given the discussion of the new AIIB and this, possible, other new bank, what does the panel think about there's been a lot of criticism of the bank over the past of the World Bank over the past couple of years, that it's kind of strayed from its mission, given its early role in heavy infrastructure financing, and that there should be a kind of a new turn towards infrastructure financing at the bank. At the same time, what the bank is going through, its safeguards reviews and all of the types of safeguards and standards that, a lot of the recipient countries, point out as one of the major kind of reasons why World Bank financing is not as attractive as it could be. So kind of given the financing needs, what does the panel think the appropriate role for the World Bank should be, as well as the other MDBs?
Well, thank you. That's an appropriately wide-ranging question with which to end, because I think we will try to wrap up. Now, Rakesh, that was a little bit in my mind when asking you about the infrastructure banks. Is there dissatisfaction with the structure or the role or the performance of the World Bank, and is this partly an answer to that dissatisfaction?
Oh, absolutely. It does seem to me, and that if I should have said this right at the beginning, that everything I'm saying is for myself, not for anyone else I represent or don't represent.
It's already moved the markets, Rakesh.
Especially if I talk about the institution across the street from us. That, in a sense, to my mind, the World Bank seems to have forgotten that it's really a financial intermediary, not a world government. And a lot of the problems that have arisen is because it seems to act as if it's a world government in terms of worrying about all kinds of things that most governments, quite frankly, should worry about, but not necessarily the financial intermediary. And that has kind of reduced its ability to fund all kinds of infrastructure projects. And what I was saying about credit enhancement, the whole value to my mind of any development bank really is that what is the development bank doing? It accumulates some internal expertise to evaluate the creditworthiness of projects or programs to which it lends, because that information is not available to the investor, and particularly for long-term infrastructure projects, and then it goes off and sells bonds to raise that financing. And the investor then doesn't need to know what's happening in that project. All it needs to know is the World Bank is being well run, or any development bank is being well run. And to my mind, there's much more of that can be done. And that's what you really need to do, is to have this bank of expertise, whether it's in water, whether it's in railways, whatever it is. And so that I feel confident that when I'm investing in a World Bank bond, an AIB bond, or a BRICS Bank bond, that this is a safe investment, which you get through the credit rating, etc. And so it seems to me that there's a lot of that can be done. And second, actually, issue there is, I think is not done enough, is the risks in infrastructure are mostly in the construction stage, and they're huge risks. Once the cash flow starts, it becomes relatively safe, not fully safe, relatively safe. And so, in fact, what development banks can happily do is to invest in something. Once that risky phase is over, you sell the thing off. And you then have very easy securitization for private investors to invest in. You can keep flipping this over. And to me, it's not done enough, so that the World Bank has a 20-year instrument or a 30-year instrument or a 10-year instrument. It doesn't need to have.
Well, once you've sorted out the IMF as a member of the executive board, you can go off to the next institution. This is going to be the last word. I'm going to ask just one of our remaining three panelists to give a very erudite last word on that point. So who would like to? Sarah, I nominate you to give the last word on the World Bank, since you are an institution yourself, very close in the great stature and respect of the World Bank, so you are very suited to make the last word.
I think it would be a wonderful thing if they would sponsor more investments of that sort. I think it would enhance transparency, it would disseminate information, and I think that's a fine idea.
Good. Well, I'd like to say thank you to everybody for being such a good audience, as well as being so attentive, and above all to our panel, Rakesh, Clay, Sonia, Sarah. A big hand for the panel. And I thought that the Global Public Investor was a fairly wide-ranging publication. I now realise it wasn't wide-ranging enough, because we've gone on onto so many really fascinating issues. So thank you very much indeed for coming, and now enjoy the reception. And thank you, of course, to Chris and all the colleagues at the Atlantic Council for laying on such good facilities today. So thank you very much indeed, Atlantic Council.